How to find stocks before they make an explosive move. Hi, I'm Ace and I built a 400k plus portfolio in just under 5 years in my early 20s by using Buffett's value principles, my bachelor degree in investments and research, as well as the real estate cycle. And today, I'm going to show you exactly how I find stocks with the potential to take off and how you can set up a stock screener to spot them out before they make a move. The first thing you need to know is explosive moves don't come from hype. They come from businesses with strong fundamentals enough to compound through cycles. Now, on a screener like TradingView, I filtered by my core value matrix. PE under 20, price over free cash flow under 15, current ratio above 1.5, debt to equity under 1, net margins above 10%, ROE above 15%, ROA above 7%. That instantly cuts all the weak names out. But here's a reality. If you do run these filters exactly the way I mentioned, you almost always get zero results. The market rarely offers a company that ticks every single box at the same time. And that's why I split my matrix into two groups. Now, some are non negotiables. So things like high return on equity, not too high of a PE ratio, and growing revenue and income, and low debt. Because without these, the businesses just aren't durable. Now, others are a bit more discretionary. So, for example, same with PE ratio, as long as they're not too high, I'm okay. Or same with margins, as long as they're above 5, 7%, that's kind of okay for me. Now, this is where I'll bend a little if the company shows signs of moat or long term growth runway. However, numbers alone don't really tell you if a company has a moat. A moat is what lets a business defend its profits against competition. Think of TSMC's dominance in advanced chip manufacturing or Apple's brand power that keeps margins high with brand loyalty while peers struggle. Now, you can't screen for moats usually, but you can use proxies. You'll see moats in consistently higher margins than peers. That's brand power. Or steady double digit revenue growth, even in tough markets. That's what I call a network effect or switching costs. Or exceptionally high returns on assets for years. That's scale or cost advantage. And once you get through all the matrix, the last thing you need to check is the real estate layer. Now, currently, we're near the end of the real estate cycle, which means even moat heavy companies will get dragged down in a crash. But those are exactly the names you want to buy once fear takes over. The moats are what let them rebound faster and hit those explosive moves when recovery begins. Now, I do break down how I build and use these screeners every single week in my free newsletter, link in bio. A question: what's the first thing you look for in a stock? Numbers, growth, or moat? Drop your answer in the comment section down below. I'll be reading.